This is Las Vegas Real Estate Now with local real estate expert Harvey Blankfeld.
Where we want to educate you about our market, empower you to make wise decisions, and help you engage with our expert contributors. So what I thought I would do today, John, is just let me be a borrower and you be the lender. It's a stretch.
Sure.
Let's go for it, though.
I can put myself in this position. I'm imagining it. Yes.
Let's see if you can play that role.
All right.
And I'm going to ask you some questions that typically come from consumers about lending, about mortgages.
Sure,
okay, so let's do that. So first of all, the first question is John, what's with all this paperwork? Well, I got great credit. What are you doing to me here?
In order to prevent bad things happening to our real estate industry and the housing market overall, we've defined a fairly, robust rule set to make sure that we're only giving loans that are relatively safe to give. And that means we have to evaluate all the characteristics of the borrower that go into their ability to pay back this money. And we basically have drawn a box that requires everybody to show that they're inside the box via their paperwork. So it doesn't matter if you have an 800 credit score and you're perfect. I still have to prove your income.
Right.
I still got to prove where you have the money. I still got to prove that you've paid your bills on
Even
time.
if I put 50% down.
Yes. Regardless of your size of down payment,
right.
I have to put you through sort of the same rigors to make sure.
John, if I use you as my mortgage lender, how do you help me protect my deposit? Now I'm going to put earnest money in on this deal. How are you going to help me make sure that I get that utilized and don't lose my earnest money?
Well, yeah, I think that's worth talking about there's two sides, really. And I think actually, and you'll, of course, know this, Harvey, is you are the primary protector of the money insofar as how you draw off that contract, right?
Yep.
And at least the contracts in our area have multiple layers that are protections for a consumer that expire over time.
Right. There are deadlines built into the contract.
There are deadlines baked into there, and each one of those deadlines has a particular aspect of protection for a consumer's earnest money deposit.
Mm-hmm.
From the loan side of thing, it's really about getting accurate, truthful information as early in the process as you can and staying engaged in the process as the consumer.
So in the transaction, I've got all this insurance going on. I got title insurance, I got home insurance, I got mortgage insurance, I got home warranties. Why do I need all that stuff? Do I really need all that stuff?
Yeah, right. Yes, I would say, they each have their value proposition, and it's worth talking about. To lay this out for consumers out there, there's title insurance, and there's actually two types of title insurance. There is what we call an owner's title policy, and then there's a lender's title policy. Those particularly all go towards insuring you against the improper transfer of your property or claims that the property was sold to you improperly. The lender's title insurance protects my loan. The owner's title insurance, which is typically paid by the seller here, protects you as the buyer to make those people go away and leave you alone. You get the house. They get paid if they're supposed to be paid. Okay. Home insurance, right, is what I easily described as fire and theft and that sort of thing, right? Hurricane insurance, these type of things. That's to make sure your home stays standing, right? And make things right for you there. That's an entirely protection for you as a buyer. Mortgage insurance is an insurance policy that makes your loan safe for the lender to give you, even though you're doing a small down payment.
Right.
So this is why instead of, let's say, your great-grandparents' loan where they had to put a 20% down payment in order to be able to get that loan from their bank, mortgage insurance came in and enabled borrowers to put a 3 or a 5 or a 10% payment, a down payment down, and still have that loan be considered safe to be able to get that mortgage in the first place.
Typically, anything less than 20% down
will trigger some kind of mortgage insurance. That is typically true.
This has been Las Vegas Real Estate Now. Thanks for listening, and remember to tune in every Saturday at 11 a.m. on 101.5 FM, 720 AM KDWN.